Hi, everybody. I'm Jeff Barton, your voice in the mortgage industry. And this is the Mortgage Minute. Thanks very much again for tuning in. We do this on LinkedIn and Facebook almost every day, about 4 times a week. We bring information to you about what's going on in the real estate and in the mortgage industries. We have a radio show that we do also on the weekends, 5 stations, 3 different states. And you can go to YouTube if you want to see and hear that, or any of the major Big 8 podcasts. We're on that too. YouTube channel is Jeff Barton, the Mortgage Voice. So Friday, let's get right to it. I listened to an interview today with Ben Carson, the I guess soon to be outgoing Secretary of HUD, and he was asked, and the specific thing that I was interested in is housing affordability and how HUD is dealing with that and what their answers to, I guess, the question of, with prices the way they are in real estate and obviously the lack of inventory, how are we helping people get into homes? And he didn't really have much in the way of specificity other than to say that he thought that the temporary, and he said that several times, issue with COVID was what was affecting the housing industry in general, but that this temporary situation would be over. I don't know if I agree or disagree with him. What I wanted to hear was, what is HUD doing to help people qualify for mortgages, even in rising real estate prices? I didn't get that answer. What I think should be happening is newer programs, a lessening of the requirements, maybe more of I guess, leeway in down payment and down payment assistance programs. These are a couple of things that might be able to help, but in general, how is HUD and what is HUD doing to help, people who are at the lower end of the spectrum get into housing? I know 3.5% is good, but the 1.5% upfront fee is not good. How can we further guarantee the solvency of FHA without, pushing these people who are having difficulty coming up with down payment out of the housing market? I also read a little bit about Mark Calabria, who is the head of the FHFA. A couple things. The final rule, which was the rule about what kind of liquidity Fannie Mae and Freddie Mac is going to have to keep in order to be released from federal conservatorship. And the other one was no liquidity for servicers. I thought this one was, and you may not know what this is, but when you get your bill from people you owe your mortgage, they usually go through somebody called a servicer, somebody whose business is it to collect the money. Some of the servicers actually own the loans. Some just act as a go-between from the person that owns the loan, and you, the customer, i.e., they do the billing and all that kind of stuff. These people have been in a bind in that the forbearance, all 2.7 million, actually went up by 30,000 this week. 2.7 million people in forbearance, they're not paying the bills. So therefore, the bank or whoever owns that or gets that payment cannot pay the banks off. So what's happening is that servicer is on the hook for the money that the borrower isn't paying, even though the borrower is in legal forbearance. It's been a bind for a lot of these servicers because they have to come up with the money to pay the note holder, who's usually the bank, or it's a bunch of different investors that are involved with that. Calabria said no. The people who are in problems or have issues with it are really a select few firms, and those firms really either need to sell off their inventory to raise a capital in order to pay those bills on a monthly, or go out of business. Kind of unforgiving guy. Sounds to me as if there should be some way by which the servicers of these loans have some kind of way out of this problem. I can't. It was so startling to me to hear that. Anyway, that's what's going on in the larger area. Let's get right to the mortgage rates, which is probably more interesting to you anyway. 2.85 for the 30-year, 2.40 for the 15, 2.35 for FHA, 3.25 for the jumbo, and the 5/1 ARM is at 2.65. They're all trading pretty lower. As we've said over the last 8-9 weeks, this trading range is very, very narrow, and we will go up and down basis points on a daily basis, but pretty much these rates are, they're still historically low. The 10-year is at 0.82. Just 5 days ago, it was 0.98. Last Friday, I guess it was that, almost a point. Well, now it's come down, which means the demand is up, so they can offer less in terms of what the yield will be. Loans taking longer to close. Yeah, that's a problem if you're in a purchase, right? We're past our time. Anyway, I'm Jeff Barton. Thanks very much for listening, and we'll see you next week.